Most Americans waste this one financial opportunity every single year, and it could be costing them hundreds of thousands of dollars.
Probably won't see it on the front pages, but make no mistake, it has the sheer power to totally redefine global economics over the next year.
So let's jump right into this mystery. Think about this. Why on earth would the United Arab Emirates, one of the absolute wealthiest countries on the planet, approach the U.S. Treasury asking for an emergency financial lifeline? Well, they were facing an energy supply cutoff after that 12-week closure of the Strait of Hormuz. And if you strip away all the polite diplomatic language, their message to Washington was basically, help us out or we're going to have literally no choice but to crash your bond market.
Section 1. A wealthy nation's paradox.
To figure this puzzle out, we really need to look at the staggering amount of wealth at play here. Because the UAE, they are far from broke. Just look at that number, $95.6 billion. That is what they hold in U.S. treasuries alone. And then you add in roughly $270 billion in foreign exchange reserves, plus literally trillions more locked up in their sovereign wealth funds. The wealth is just mind-boggling. But here's the catch. When your cash flow suddenly dries up because you can't sell your oil, well, you've got to dip in your savings to keep the lights on and pay the bills, right?
Section 2. The global dollar asset.
Okay, so when the U.S. government spends more money than it brings in, which, happens a lot, it borrows the difference by selling IOUs, basically, treasury bonds. And if you look at the foreign central bank holdings right here, Japan is sitting on a staggering $1.2 trillion. The UK has $895 billion, and there's the UAE right alongside them with their $95.6 billion. It's historically been this flawless setup, right? The U.S. gets to borrow super cheaply, and nations all over the globe get to park their savings in the safest asset in the world, U.S. dollars.
Section 3. Anatomy of a debt spiral. But, as it turns out, this system has a really critical vulnerability. Let's break this down with a quick, simplified analogy. Let's say I loan you $1,000 for 5 years at 5% interest. Great deal for both of us. But 2 years go by and I have a huge emergency. I need cash like yesterday. I can't wait 3 more years for you to pay me back. So I go out and find a third party, and I basically beg them to buy this loan off of me. Now, because they can smell my desperation a mile away, there's no way they're paying the full $1,000. They lowball me and offer $800. I'm desperate, so I take the hit, I take the $800. Now think about that third party. They just bought a guaranteed future payout of $1,000 for only $800. Their effective return, or what the Wall Street folks call the yield, just shot way, way up.
Now, I want you to imagine that exact same scenario happening but on a massive global scale. When foreign nations are suddenly desperate for cash to go buy fuel on the open market, what do? They start dumping their most liquid asset, U.S. treasuries. And they're all doing it at the exact same time. Well, when everyone rushes for the exit and sells the same asset, prices absolutely plummet. It's simple supply and demand. And as bond prices plummet, interest rates, those yields we just talked about, they skyrocket. And here's the truly terrifying part of all this. The U.S. government still needs to borrow money to fund its own deficit. But if investors can just go buy existing bonds at a steep discount, the U.S. government is forced to offer much, much higher interest rates on its brand new bonds just to get anyone to buy them.
And listen, this isn't just some abstract, high finance Wall Street thing. This impacts you and me directly. See, Treasury yields don't exist in a vacuum. They set the baseline for literally the entire economy. A massive sell-off like that instantly makes your everyday borrowing. We're talking mortgages, car loans, credit cards, corporate debt, so much more expensive. The entire U.S. economy would be put under absolutely crippling pressure.
Section 4. The emergency swap line. So, to prevent this catastrophic domino effect, Washington sat down and negotiated an alternative with the UAE. It's called a currency swap line. Basically, this is an emergency credit facility. It allows the U.S. Federal Reserve to lend dollars directly to a foreign central bank. In return, the foreign bank pledges its own currency as collateral at a fixed exchange rate, and then, eventually pays back the dollars with interest. The genius of it is that it completely bypasses the need for that foreign country to liquidate their U.S. assets and crash the whole system.
Section 5. The hidden U.S. bailout. Which brings us to a really fascinating twist in all of this. Is a swap line a bailout? Well, critics on one side argue that yes, handing out billions of dollars to a cash-strapped nation is absolutely a bailout. But on the flip side, U.S. market bulls argue no way. These are just short-term secured lending facilities that always get paid back. They aren't bailouts at all. But if we strip away all the partisan politics and just look at the raw mechanics of the deal, both of these groups are actually looking at it completely backwards.
The counterintuitive reality here is perfectly captured by this quote.
It points out that this isn't just about helping out a foreign central bank, it's actually about preventing that bank from becoming a forced seller of U.S. government debt. So, when the Fed opens up one of these swap lines, it isn't really a bailout for the borrower getting the dollars. Actually, scratch that. It's more like a hidden, self-preserving bailout for the U.S. Treasury market itself. By handing the UAE those dollars directly, the U.S. is protecting its own interests and preventing a massive, devastating sell-off of American debt.
And because of that, Wall Street is now anticipating that these swap line programs are about to expand dramatically. First off, they expect the U.S. to cast a much wider net, moving from just lending to highly reliable allies to partners with, let's say, much less stable currencies. Second, we're likely going to see a shift from these being temporary emergency loans to just being permanent fixtures. And finally, they'll likely rely on a classic strategy known as amend, extend, and pretend. That's where the Fed amends the terms to extend the deadlines, and basically everyone just pretends the loan is totally fine while they roll it over indefinitely.
Now, if you're wondering if this prediction is actually materializing, the evidence is pretty stark. Just look at this number: 0. Kuwait exported exactly 0 barrels of oil in the month of April 2026. 0. For an entire month. That is absolutely wild. Something like that hasn't happened in over 30 years.
And this is incredibly significant because oil revenues fund roughly 90% of Kuwait's entire government budget. When you have literally no oil revenue coming in, well, you still have a country to run and bills to pay. And it just so happens that Kuwait holds about $66 billion in U.S. treasuries. So are they the next domino to fall? Because if they run out of cash, they've really only got two options. They either become a forced seller of those billions in treasuries, which would trigger that exact devastating debt spiral we just outlined, or they follow the UAE's lead and ask Washington for a massive dollar swap line of their own.
So what does this all mean? The ultimate question I'm going to leave you with today is this. As global pressures continue to mount and cash flows get tighter and tighter around the world, will the United States just stand by and let desperate countries crash the Treasury market, causing borrowing costs for every single American to skyrocket? Or will Washington continue to quietly bail itself out